We now move to discuss financing from debt, which is purely an external source of finance. Like equity, debt can be issued publicly in the form of corporate bonds, which needs ASIC registration. Public sales are made through an investment banking firm that purchases the bonds from the issuer and resells them to the investors. Some corporate bonds are traded on the ASX, but most trading occurs through dealers. Or debt can be issued privately in the form of loans or private placements. Private placements are not very common in Australia and are mainly used to issue bonds into the US market. Corporate bonds are less liquid than money market securities. The low liquidity stems from the more complicated features that make valuation difficult and the longer terms to maturity of bonds. One of the reasons managers choose debt financing instead of equity financing is that it costs less than equity. However, this cost of long-term debt in turn is influenced by these factors. The longer the maturity of the debt, the higher the risk of default and therefore higher cost of debt. The bigger the size of the debt, the less admin costs will be. However, with size increase also comes high exposure to risk. Risk of the borrower is positively related to the interest rate charged by the lender. If the firm has high operating leverage, it means high volatility of cash flows or higher debt-to-equity ratio, which means more leverage and in general riskier firm. The greater the yield on government bonds, which are considered risk-free, the greater the rate charged on other loans, which are considered risky. First, let's remind ourselves some features of the bonds previously discussed in Module 4. When the company issues bonds, they're borrowing money from investors. In turn, they promise to pay them regular cash flows in the form of coupon payments. The maturities for corporate bonds range from 10 to 30 years and have a par value or face value of $100 or $1,000. At the time of issue, the bond contract or the bond indenture specifies all the details regarding the coupon rate or interest payments, their frequency, annual or semi-annual, the term to maturity, and the face value. Also, the contract specifies if there is any collateral or security backing up the debt issue, and the priority of payments in the event of default. The contract lists the trustee in charge to protect the debt holder's interests and any restrictive covenants or alternative retirement provisions. These are the types of bonds based on their security and interest payable. Insofar as Australian corporations law is concerned, notes and bonds are within the broad meaning of debentures. Debentures may provide greater security to lenders as they have a charge over specific assets and they have priority of claim. Secured notes are similar to debentures but are backed up by a second mortgage over assets. Holders of unsecured notes and bonds are simply unsecured creditors in the case of liquidation. Convertibles, as the name implies, are debt securities that can be converted to ordinary shares at maturity. A fixed income bond pays fixed periodic, usually semi-annual coupon interest, and the principal is repaid on a specified maturity date. A variable rate bond, also known as floating rate bond or floater, pays coupon interest at a rate that floats with either the yield on government T-bills, the LIBOR, the firm's credit rating, or some other formula. A pure discount bond, also known as a zero coupon bond, pays no coupon interest whatsoever, while a deferred coupon bond commences paying interest after a specified deferment period of 1 or several years. International bonds are of two kinds: Eurobonds and foreign bonds. A Eurobond is a bond that is issued by an international borrower and sold to investors in countries other than the country in which they are issued or denominated. A Eurobond is typically issued in a single currency, frequently dollars, in many countries. By selling Eurobonds, many multinational companies finance their global operations, especially in the countries in which they do business. Eurobonds are also a source of intermediate and long-term financing of sovereign governments and supranationals, like International Monetary Fund and World Bank. A Eurodollar bond that is denominated in US dollars and issued in Japan by an Australian company would be an example of an Eurobond. The Australian company in this example could issue the Eurodollar bond in any other country other than US. Or, another example, a Russian bank issuing Australian dollar denominated Eurobond to be sold in the US. In contrast to a Eurobond, a foreign bond is a bond issued in a host country's financial market in the host country's currency by a foreign borrower. This bond is subject to the regulation imposed on all securities traded in the national market and sometimes to special regulations and disclosure requirements governing foreign borrowers. Many of these issues have colorful nicknames such as Yankee bonds, which are dollar-denominated bonds issued by non-American borrowers in the US market. Samurai bonds are yen-denominated bonds which are issued by non-Japanese borrowers in the Japanese market. Bulldog bonds, pound sterling denominated bonds which are issued by non-British borrowers in the British market. And Heidi bonds, for example, franc denominated bonds which are issued by non-Swiss borrowers in the Swiss market, and so on. Rembrandt bonds, Matador bonds, and so forth. The other type of debt are private loans given out by financial institutions like banks, insurance companies, pension funds, and others. These have maturities of more than 1 year, generally around 3 to 7 years. Companies negotiate the term loans directly with the lender, where they agree on things like the payment dates, their frequency and size, any collateral requirements as to the assets to serve as security, any share purchase warrants that allows the bank, for example, to purchase a fixed number of shares at a specified price over a fixed time period in the future. Whether the debt is public or private, it usually comes with some contractual clauses or covenants that constrain borrowers' action. These loan covenants can be positive, such as maintaining good records, have enough liquidity, and use the funds on certain projects. Or they can be negative, things that borrowers should not do, things that increase the risk of the firm, such as prevent firms from selling certain equipment or use them as collateral, issue more debt, and avoid certain types of leases. Like that, having a lease involves periodic tax-deductible payments, either fixed or variable. The two parties to the contract are the lessor, who is the owner of the asset, and the lessee, who is the user of the asset. There are two basic types of leases. The first is the operating leases for assets with short lives like photocopiers machines, computers, and cars, where the lessor has the option to cancel the lease by paying a cancellation fee. Also, the lease payments will never fully recover the lessor's original cost of the asset. However, the lessor can make up the shortfall by renting the assets again to the same party or to others. Financial or capital leases are for long-lived assets, like plant and equipment, and cannot be cancelled. Also, its combined payments exceed the original cost of the asset. These are various lease arrangements that can be agreed on when entering a contract, which depend on the desire of the prospective lessors. Direct leases, when the lessor acquires the assets to be leased by the lessee who did not previously own the asset. So the lessee has a say in what asset they want. We also have sale-leaseback arrangement, when one company sells an asset to another for cash, then leases the asset back from the new owner. This form of lease is attractive for companies that need cash and are willing to exchange a promise to make periodic lease payments for immediate cash. Leveraged leases occur when a third-party lender is involved. The lessor provides only a portion, say about 20% of the asset value. The lender provides the balance. These are popular as they provide a way of structuring very expensive leases where the lessor doesn't want to tie too much capital in one asset. Leasing arrangements usually specify who is responsible for maintenance of leased assets. For operating leases, it is the lessor, while for financial leases, is the lessee. Leases also have renewal options, which can only be applied on operating leases, and options to purchase the asset when the lease expires. These are some of the advantages and disadvantages of having a lease. Sale-leasebacks may permit the company to increase its liquidity by converting assets into cash, which can then be used as working capital. Leasing provides 100% financing, as opposed to loan agreements which require a down payment. In the case of insolvency, the lessor can take back its leased assets quickly and relatively easily. The lessee avoids potentially restrictive bond covenants. And leasing may provide more financial flexibility through operating leases where the company doesn't have to arrange financing for small, low-cost assets. These are some of the disadvantages. A lease does not have a stated interest cost, and borrowing may be less costly for the company. At the end of a lease agreement, the lessor realizes the salvage value, not the lessee. A lessee is generally prohibited from making improvements on a leased property or asset without the approval of the lessor. Also, if a leased assets become obsolete, the lessee must make these payments over the remaining time of the lease.